Welcome to Real Estate Economics webinar series. I'm John Mulville, and I'll be leading July 17th's webinar on new home market trends, a quick look at foreign demand, and a general overview of opportunities in foreclosures. Now, this is covering the 11-county San Francisco Bay Area. So obviously we have a very large geographic area, very large market area, many different submarkets in terms of employment characteristics, housing market characteristics. So we're going to make this a very global view with some commentary about some specific market areas. This particular graph shows quarterly market statistics collected for the last 6 years. What we'd really like to call your attention to here is the number of active developments in this 11-county area. It's only 152. If you dig into that somewhat deeper, the count for developments that are not on hold or suspended due to feasibility, financial, or what other problem might exist is only 137. Approximately 20% of that 137 is down to its last quarter or two of inventory. It would be our practice to carry those new home developments in this community count until the last unit is closed. So there are developments in there that might have model homes left, build-out lots, parking lots, or just a plan or two left that are going to go sold out in the next quarter or two. So community counts have absolutely cratered in this very huge region. If you look at on a county basis, Santa Clara County has just 28 active new home developments, Contra Costa 35, and Alameda 38. So if you total those up, there's very, very limited inventory in any of the other counties within this 11-county area. A couple of other trends we'd like to call out. Unit sizes as we entered the recession and a very weak post-recession period, unit sizes were shrinking. Builders were making great efforts to improve affordability through higher density concepts, and lot sizes were coming down at the same time, obviously, as the densities were increasing. That trend has started to reverse. Some of the higher density concepts were not that well received, and the greater affordability was offset by functional and ownership cost issues. So we have seen a little bit of a trend change there. In many family and suburban markets, the detached home is still strongly preferred. Although, of course, we know we have urban areas where the tech worker and that sort of thing isn't interested in a single-family house. But we have certainly seen people take the lower density product when it's available in many, many market areas. Lastly, average sales rate for development, highlighted in blue, you can see at the bottom of the table, has climbed back up from 1.6 to 2.8 per month. Just a note on how we calculate that. That would be calculated by the periodic figures of sales per month over the life of these different developments, these 152 developments that are in this survey. So what happened 6 quarters back, 10 quarters back, some of these communities were selling 1 a month, 1.2 a month, or even less. So those numbers are all in these averages. The bottom line on that is there are many communities that have been introduced more recently that are in sync with buyer demands, are in sync with the financial capabilities of the market, that are selling at above 2.8 per month. Let's look at the same area in terms of prices. Prices have continued to draw down here. Now this is less a reflection of some price decline or overall price degradation as it is a repositioning of product. As we all know, builders have gone to more efficient designs. They've cut out some of the over-the-top amenities and just generally tried to improve their values and improve their prices at the same time. So we've seen homes come back much towards where people could afford them over time, and that's a process that is ongoing. You can see that same characteristic in the average price per foot data, down about 22%, but not all of that is just taking that same home and shrinking the price 22%. There are tremendous efficiencies being secured in design, in purchasing, and in the complete specification package that's going into a home in 2012 compared to the year 2007. In terms of sales, you can clearly see, sales have, essentially cratered since 2007 in this market area, but have bounded higher in the last year. There are many areas and submarkets within this huge 11-county region where new homes are very poorly supplied. We could clearly achieve higher absorption if there were more homes on the market, but the month's worth of inventory data has gotten very, very low at this point in time. This market could clearly absorb more homes if supply levels were higher. As we promised, a quick look at foreign demand. Now, typically this has been something that people have tended to think of in terms of foreigners buying penthouse condos in Miami or Park Avenue condos in New York or Pacific Heights in San Francisco. Doesn't matter what, that it was somehow limited to the extreme high end. We're going to put out a couple of statistics today to show you otherwise and talk about them in greater detail. As you can see, 82.5 billion in total sales to foreigners in 2011, about an 8.9% market share, up from 7.7 the previous year, so the trend is significantly higher. In 2011, that 82.5 billion would average or equal 371,000, almost 372,000 homes at the then equal median home price figure. New homes for that same year were only 303,211. So foreign buyer demand is greater by volume than the new home market was in 2011. There's quite a few interesting dynamics in this. We'll talk to that first here. This shows where foreign buyers are coming from by nation of origin. And some of these are quite significant. On the far left is Brazil. Many people think, well, Brazil, why is Brazil giving us a lot of people? Brazil is now the 6th largest economy on the globe, having recently passed England. Brazil's really a country with everything. It's got a good population base, it's got resources, it's got investment capital, all the dynamics of functioning in a good economy are there, except the government tends to be very involved in the economy. We've had some problems there with inflation, so the government raised rates and economic growth decelerated. Some of that is being sort of foisted on them by the weak dollar, but this is a place where people of means are taking some of their money and looking for safe places to put that across the globe. Same is true in Canada. Same is true in China. Same is true in India. Some of the other countries don't contribute much foreign demand. Their numbers have been quite stable for years. Just a quick point on Canada. It is possible to immigrate to Canada from many Asian countries, so there are considerable numbers of people migrating to Canada from Asia and then turning around and looking at U.S. real estate. Our discussion of foreign demand really ties directly into foreclosures for a couple of points that we'll talk about here. Now, almost everyone now has heard about foreclosure buying and the opportunities there, and everybody knows prices are low, you can get a quick positive cash flow, and so on. We think there are a number of less obvious but equally important reasons why this market needs to be on your radar. Economic upheaval across the world is forcing people and capital out of these countries, at least on a part-time basis, and sending them looking for secure markets to live for one, to invest for another, and to maintain the value of their wealth. Many countries are devaluing their currency. Bank outflows in the Eurozone have totaled billions on a weekly basis, and all those billions are looking for some place to stay. The U.S. is really at the top of that list. The U.S. can provide generally what many of these countries struggle with, and that is physical security for one, decent food source, decent water, safe living, decent schools. Many of these countries are challenged with one or more of these things, characteristics, and the U.S. has most of those. Additionally, we've got human outflows, as we all know. Mexico, China, many of these places. The Middle East is increasingly unstable, and again, people of means are leaving there looking for a safe place to live. Those are long-term trends. Those are not going to go away, next week or next month or next year. And it doesn't all correlate to the foreclosure market or correlate to demand for distressed homes. But many of these people will, one, want a personal residence, but they may also be interested in residences for relatives and even building, rental unit portfolios to have a source of income outside of their home country. The last point here, the Basel III banking rules that are being implemented in the next few years require banks to maintain higher liquidity coverage ratios. And one of the ways you do that is by holding quality, and I mean high quality, corporate bonds and government bonds that aren't as readily available in some of these countries as they are in the U.S. And that will limit the ability of foreign banks to establish a sufficient capital base to make loans. That really makes credit availability better in the U.S. And really makes it more attractive to come to the U.S., buy in the U.S., and borrow in the U.S. So let's talk about on a little more granular level. If you want a foreclosure, where do you go? What do you buy? Why are you interested in this place or that place, this unit or that unit? Most of the people who leave a distressed home will stay very, very close to their previous home. If they were employed, they want to stay close to their employer. They want to stay close to their kids' schools, their grocery store, their social connections, the different things that attracted them to that place initially. Now, a lot of times people lose jobs, but essentially gain the jobs in the same field, same industry, and can stay in the same area. So a lot of people will try to stay close. We would just recommend employment will be everything in these next few years. So stay close to employment if you're purchasing foreclosures. We like moderately older neighborhoods and preferably detached units. We think associations, homeowners associations, are under tremendous pressure at present. They are having a hard time collecting their dues from all their owners. Association budgets are going to be pressed in the next few years due to energy costs, insurance and liability costs. Many structures are aging, requiring greater maintenance. So we see a lot of pressure on homeowners association budgets, and as it turns out, there are quite a few businesses, cottage industry you might say, opening up to help associations deal with their budget problems, past, present, and future. And our last point is we might not be attracted to foreclosures in trendy areas. We think areas that have a lot of new apartment supply coming online. Rents have grown very, very quickly in a lot of markets, and newly constructed apartments may be opening at rents near the top of their market and not have that much upside in some places, which puts pressure on Class B and Class C rents, which compete with single-family landlords. So pick your spots carefully. Think of the rental value, not just for today, but for a few years down the road. This closing distribution report shows the percentage of sales in this 11-county area for May 2012 by living area square footage. You can see the three highlighted areas are 1,000 square feet to 1,749. Now this is obviously a real bread and butter home size range, so it's hardly surprising that that's where the largest volume is. We would maybe take the leap of faith here that if you're going to buy such a unit at a foreclosure and hold it for 5 or 10 years and then sell it, you might want to move up the size ladder a little bit and go into a slightly larger home. It's relatively inexpensive to buy that additional footage at this point in time, and it will really help you on the resale market 5 or 10 years out. We also see a tremendous increase in multi-generational living and that household will prefer larger homes and higher room counts, and we'll talk to room counts right now. Across this 11 county area, more than 40% of the units report 3 bedrooms. So that's, really the core of demand. Now, obviously, many apartments are 2, many larger homes are 4. It might be a good way to differentiate yourself now and in the future, and also meet demographic trends by going to 3 or 4 bedrooms in this particular area. We also see people be cautious of pools and be cautious of sources of liability. You do not want to be building a portfolio of foreclosed homes and then have a problem with a pool in a backyard. So the liability associated with that pool can be a significant issue. Stay bread and butter. Stay in the high rental demand areas and high rental demand markets. We'd like to talk about where we are in terms of timing in the overall foreclosure market. Obviously, people have been getting foreclosed for quite some time, so we get questions about, well, where are we? Are we in the first inning of this game, the 5th inning? Is it the 8th inning? Is it the 9th inning? It's certainly not new. People have been out buying foreclosures for quite some time, but we don't think we're that close to the end. One of the ways, a little bit different way of looking at this, is we're going to compare in this particular chart. The green line is the Home Construction Fund exchange traded fund. It's like a stock or a mutual fund, more like a stock where it trades every day, consists mainly of home builders. That's the green line at the bottom. The red line is the Standard & Poor's 500, so we can compare the home construction industry to the Standard & Poor's 500, Standard & Poor's shown in red. And last, black, is good old Home Depot, where we buy drywall and carpet and screws and furniture and fixtures and anything that might need to go into a foreclosed home. We're going to call out Home Depot in this particular graphic as really taking off and outperforming the Standard & Poor's 500 and the home construction business. Home Depot was picking up a lot of revenue from remodelers and people buying these homes, and that translated into better earnings and a better stock price. So you can really see when the stock market caught wind of this and began to understand the processes that were in play. And that process, as we read it through Home Depot, is that the remodeling side of the business is certainly as attractive as the new home side and as the general stock market overall. Take another twist on that. Here's our good ITB. That's our home construction ETF that was in the green line before. It's in the blue line now, plotted at the top, compared to Ethan Allen, the home furniture retailer. Our read on this is that rental investors typically have good financial resources. They're busy. They're out there buying, selling, remodeling. Home builders are also doing reasonably well. But individual consumers are still relatively stretched. There's a lot of people trying to rehabilitate their household balance sheet, trying to improve their savings, trying to get their credit cards back. And that's translating into lackluster sales on a lot of consumer goods items. So that is really our view of the weak link of the chain. We see many people coming into FHA loan deals with relatively limited cash, and even where home sales, especially low-end home sales, are performing okay, a lot of times those buyers don't have that much money. All the point to all this being is that the remodel and rental investor side of the market looks pretty compelling at this point in time. Let's take a triple check. Since we looked at it from a couple of other different ways, let's look at it from a traditional valuation approach. Many of you recognize this from our residential economic reports. The blue line is the historical median home price line, or the forecast in the later years of the forecast. The green is our supportable median home price line. Now, where do we get supportable? We know the incomes in these areas. You can find the income for even a neighborhood on the U.S. Census. We know what interest rates are, and we know what portion of the household income people will typically dedicate to their house payment. Those numbers go back years and years and years and are trackable and trendable. So we can see what those look like. Now come to January 2013 is where the dotted blue line vertical. Look at that spread there. That essentially represents the undervaluation, the differential between what people could pay for a home in this market area, with the blue line being what they have been paying or would have paid in the most recent period. That spread again is significant undervaluation. So we are still in the early stages, maybe not the earliest stages, but particularly for this area. The Bay Area tends to be a little bit farther along in its recovery. If we looked at many other areas across the country, there would be several years before the blue and green line crossed, which essentially represents an equilibrium condition. Now think of what happens in these markets when rental investors buy all of the least affordable or the least expensive homes in any market. That pulls the median price up over time. So if you're hearing on the news a lot of reports about median price improvement, part of this is drawn or is being created by less market capture, less percentage of sales, and lower volumes in the lowest price ranges because the rental investors have been there buying these for months. So, where will the distressed inventory come from? Do we have enough to, work a business out of this? Are we at the end or are we at the beginning? Well, we know that a lot of people remain underwater, and how much they are underwater is very, very significant in many areas. There comes a point where you're sufficiently underwater, you can't amortize your way out, and the amount of appreciation we're forecasting for the next 5 or 10 years won't get you out either. So we think there's many foreclosures to come. It's certainly a strong part of the current market. Maybe they won't be direct foreclosure sales. We see lenders really migrating to short sales, but there will be abundant distressed inventory for at least a few years here. Major point affecting this market, Mortgage Forgiveness Act. Up until 2007, if you short paid your home, you could have received a 1099 for income relating to the forgiveness of your short pay. If you paid your loan short, that could be considered income and a taxable event. President Bush signed that away, and California matched that back in 2007. That will expire at the end of the year in 2012. That is motivating people who haven't even been called by their lender about not paying their mortgage to get that place short paid and get out of there and avoid the potential tax liability. Now, Congress could extend this. Your lender may not even 1099 you for this income, but that's a risk that not all people are willing to bank on. Basel III, we talked about this a little bit earlier. This requires lenders to hold capital against loan servicing. If you understand and know this industry a little bit, many lenders acquired loan servicing portfolios. They could take a little percentage off the monthly payments, relatively low risk industry historically. And you didn't have to hold capital against that. Now all banks are under such pressure to build and maintain their capital levels that this becomes an issue because now you have to hold capital against servicing rights. So many banks are offloading, selling their servicing rights just as quickly as they can, and servicing has been transferring from big lenders to other general purpose companies that aren't organized as banks. Many foreclosures coming out of FHA. Many more foreclosures are also coming out have come out of the private sector already. The private sector has been reducing their distressed assets for years, and now at this point in time, most of the distressed properties, as we understand it, are held by GSEs, government-sponsored entities, and under the FHA, FHFA umbrellas. Last point, B of A alone, come across this in the Wall Street Journal a couple of weeks ago, has $16.1 billion in pending applications to repurchase loans that were part of residential mortgage-backed securities pools that are out of compliance when they were sold with investor requirements. Now, many of the banks, when they've had to make these repurchases, if they've finally been forced to make them, don't hold these and put these back into servicing because, as we've just pointed out, you'd have to have capital against those, and they immediately turn around and resell those. So we believe there are many loans, many mortgages out there to come into the market for foreclosure investors in the next few years. Another look at distressed inventory here specific to this particular market. We show notices of default, foreclosures, and foreclosure sales. As we mentioned, foreclosure sales are drawing down quite significantly. Lenders are far more comfortable with short sales. Short sales are clearly the new preferred approach to dealing with distressed inventory, and we think this will probably carry on for the next few years. Total housing inventory. Now, this is on a parallel point here. The housing inventory in this 11 county area is growing very, very slowly. It has been for a while, but from 2007 till 2017, it's only 0.5% a year. If you do the quick and easy math on that, that means the housing stock, a typical house, needs to last 200 years in this area before it's replaced. Part of having a competitive economy and providing housing to workers and providing bases for companies and industry to locate is to have a decent housing market. So it's very tough on the competitiveness of an MSA or a region to go for extended time periods without bringing some new housing into the market. To that point, we think housing picks up, the production of housing picks up. People are looking to reuse any possible site. We've seen teardowns of server farms, teardowns of industrial parks, movie theaters. Outdoor movie theaters are long gone. Underutilized retail. All kinds of different uses are being rezoned for housing, and that will continue because there's obviously demand for housing just on a demographic basis, if not quite yet a financial basis. Median home prices. You can see what this areas look like. Severe run-up into subprime, huge drawdown into 2010, but now a pattern of appreciation for the next couple of years. Part of this will just be offsetting the undervaluation we showed in an earlier slide, but as the economy picks up a little steam and starts to improve, appreciation gets to be quite a bit higher in this particular market, and we'll talk a little bit about the employment profile here in a moment. Just one final note, values deeply overcorrected to incomes. We talked about this a moment ago. That's the point of our undervaluation in an earlier slide. Let's look at household incomes. Household incomes are already pretty decent in this market at about $75,000 per household. Now if we look separately at tech pay, Silicon Valley tech pay for the average worker, $104,195 compared to $87,000 in LA, $85,000, almost $86,000 in San Diego. So the tech base in this area is a big boost to the economy. It's really proven to be a draw for workers, business, and entrepreneurial capital from around the world. I don't know if anyone follows the rankings of the business climate in the U.S. recently, but California was rated 40th out of the 50 states, and really the things that it had going for it was innovation, where it was highly ranked, and access to venture capital and investment capital, where it ranked number 1. Without those ratings, it would have been a much less attractive picture. So really, what are our conclusions at the end of the day? Rental investors have been clearing out the lower price rungs, but we still think investors have enough yield margin room that they can move up the price ladder a little bit. If they don't want to do that, there's always niche opportunities, and we would even encourage people to look at different niches and to find property types and locations that they're comfortable with. It's obviously difficult to service a portfolio of foreclosed homes when they're geographically diverse. That's obviously been one of the big problems with bulk sales. That same applies to a smaller scale rental investor. Pick a market area and find expertise in it. But slowly over time, these lowest price homes are being cleared out. Competition, as we recognize, if you talk to people who go to the foreclosure sales, these have become very, very competitive. Multiple offers on almost all short sales that make attractive rental. So this part of the market's been very, very active, and it's gradually forcing buyers up the price ladder, which, as we mentioned, is helping median home prices. We've also encouraged people to look at the neighborhood, look at the employment connections, look at the commuting connections. Don't just pick a deal for today because it's very, very low priced and undervalued. Think about 5 and 10 years out when you want to re-enter the market and sell that home. What's the seller look like, or what's the buyer look like then? What's the market look like then? And what characteristics will help you and your exit strategy? Recently, I saw an interview with Sam Zell. Many of you probably recognize his name. He's one of the major owners of Equity Residential, the largest apartment REIT in the United States, or one of the largest. He said management was very difficult on his apartment complexes, which averaged about 415 units each. So if you took that difficulty in managing residential units and applied that to units that were spread all over a city or a county, he just wasn't quite sure how rental investors were going to deal with that. You certainly can't treat a portfolio of rental homes like you would an apartment complex, because the expenses won't be the same, management won't be the same, cap rates sure shouldn't be the same. So think about your area of concentration, think about your service and trade areas. At present, there are about 25.5 million rental single-family units compared to 18.1 million apartment rental units. So the fact that many single-unit homes are ending up in the rental stock is certainly nothing new. And there's really no reason why a given home, given single-family home, can't move between the rental market and the for-sale market as market conditions demand. Come to our website. You can take a look at our webinar schedule. Many of the things we presented here today are from our various online resources: Residential Economic Report, our closings report, and our new home market data. If you have any questions, again, I'm John Mulville. Here's my contact information. We're happy to field questions about the market in general or anything we present today. If you're interested in subscription or customer service information, Judy Duell contact information right here. Please check our website for upcoming events, and thank you very much for joining us today.